I'm Jacqueline Matoza. I'm a retired CPA. I worked with billionaires and Fortune 25 companies working on tax planning, not tax strategy. It doesn't exist in corporate America. And I did it for 16 years. I decided to leave corporate America and help self-made millionaires because you're the most underserved and 70% of your CPAs are gonna retire. Let's chat about how to reduce your income or your taxes. And I'm gonna rate what people come and bring me in my profile between a 1, a 2, a 3, a 4, or a 5, based on if you are a W-2 earner or if you have a business. And this is really important because businesses have a different profile, different deductions, more deductions than W-2 earners. So I am talking about this right now in October of 2025, okay? And this is very important because economies change, macroeconomic indicators change, microeconomic indicators change, industries change, everything changes because the only thing constant in life is change. So this is for this time. We're in the fall of 2025 and where my advice is going. So let's talk about this. If you are a W-2, I'm gonna do W-2 first, and then you can fast forward if you wanna know about businesses, but most people have a W-2, even if you're a business owner, if you're doing things right, the proper way, you have a W-2. So let's talk about deductions that W-2 earners like to take in their 1040 tax returns that, quite frankly, are just not good. So 1, I am at the bottom of the barrel. So let's talk about this. The Augusta rule. Super trendy, super clickbait. Everyone's like, oh my God, the Augusta rule. Guys, this Augusta rule is only gonna get you tens of thousands of dollars maximum, okay? We're not talking 6 figures, we're not talking 7 figures. It is not gonna help you if you have a rental property and you rent that property out to your business, whatever it is. The Augusta rule is not gonna help you. It's actually gonna put rental income into your 1040. It's gonna put an expense in your business, and you're basically just shifting something from one side to the other side, and it's stupid. It's a waste of time because now you have a 37% tax bracket problem versus if you're making $250,000 as a business owner or $500,000 married, single, married. You wanna get this into a C Corp, and then you're just really, it's not beneficial because if it's a flow through and you have an expense and an income, nets to 0, again, worthless, stupid. So I think the Augusta rule is really stupid, and that's my 10 cents, because if it flows through, which 99% of people are on flow through S Corps, because ooh, that's 1986 tax code, let's do that, it's gonna eliminate. You're gonna bring an expense in over here, you're gonna have income over here, doesn't matter. So renting out a rental property, pretty much benign, no point. Waste of time, waste of paperwork, waste of accounting fees, legal contracts, whatever. Then we've got certain real estate investments. Let's talk about the state of the affairs in our real estate market. Highest leverage ever in American history today. We are at 2008 repossessions of vehicles level. We are at 2011 foreclosure levels. I looked in Las Vegas where I live. We have 427 pre-foreclosure, foreclosure, auction homes going up right now. So not a good time. You don't want to buy high and sell low. You want to buy low and sell high. That's the Warren Buffett model, right? Buy low, sell high, make your money, get out. I bought in 2010-11. I sold in 2020. I rode the market. I made a lot of money in that time frame. Am I buying right now? Only if it's 50 cents on the dollar, foreclosure, sub 2 deals. But let's talk about this. We do not want to buy right now multifamily housing. Why? It's over leveraged, overdone, overdrawn. We, as 2030, will have more housing than we know what to do with based on the developed allotted permits right now. So multifamily housing, sorry, bad spelling, multifamily housing is overdone. It's gonna take you 3 to 5 years to build, 3 years to convert. You're already getting close to that 2030 number. You don't wanna do multifamily. That's something we did back in 2016, made a boatload of money. Not anymore. It's a fad, it's over, it's done. Short-term rentals. Again, when you're at the peak of the market, foreclosures are happening. We're seeing layoffs. Accenture just laid off 11,000. Amazon announced 30,000 people. The layoffs are coming. In typical years, layoffs happen after Thanksgiving, before Christmas. We're doing it in October, guys. We're announcing in October. bad. Red herring, not good. Be careful. Short-term rentals follow hotels, right? If you have no money, how do you travel? You don't want to be investing in these things because you're going to make no money. If you make no money in a downturn, you now have a bill. Guys, we don't want to be doing that. That is not what we want to be doing. And then single family residence. Again, if we're at the peak of the market, everyone's losing their jobs. Wait 6 to 9 months. The market will start to slide because everyone runs out of cash. The banks start to get into foreclosure, notice of default, and this is a whole process. So right now in real estate, I would not touch multifamily, short-term rentals, hotels, or single family. That is no-go zone, okay? The other thing I don't think that works, and I'm happy to talk to you if you do this, charitable deductions that are leveraged. So this is where you're buying something, and then a couple months later, you're donating it. Nothing in your right mind in a downturn that you buy today is gonna 5x in 2-3 months, okay? Now, if you're buying real estate subject to the mortgage is 100 grand, the property's worth 600 grand, okay, we got a 5x multiple on that, all right? Fine, you win. But I don't know how the heck this is going down in the public space. I get told and asked this all the time. If I was a CPA signing the return, I wouldn't sign off on it. So you can't buy something a couple months later, even 12 months. Nothing appreciates 5x unless you are coming out of a downturn, which is slingshotting and catapulting, and you're buying right, okay? IRAs. If your CPA's advice is do an IRA, guys, that's like maybe $7,500, like not gonna help you move the needle on your tax bill. And that is before above the line deductions. If you don't know what that means, go look at my other videos. It's an above the line, which means you have to multiply by a tax rate, which then you get the deduction, okay? Not good. Then basically these other things people do, they buy vehicles, okay? Vehicles, if you don't need it, don't buy it. It's a depreciating asset. Very rarely, which we saw in COVID, did you buy a vehicle and it went up in value, okay? That is an anomaly. That is not typical. Yes, you get the one-time deduction, but that's all you're getting. And then you have a fancy car and it's not gonna do shit for you. It's not gonna earn you money. It's not gonna do anything. So this area, if you have a W-2 and you have flow through income, be careful, guys, because you know, all these Schedule E's and flow through line 8 on your 1040, if you don't know where that is, go back to my other videos. These items coming through a Schedule C, Schedule E, they're not helping you. They're not helping you get where you need to be, okay? So the second worst that I would tell people to do is solar tax credits. Why? Because you don't even know if you can take the tax credit. You don't even know if you qualify. And this is where you need to make sure you understand the legal contracts, because what's written in legal does not always work for tax, and what works for tax doesn't work for legal. And we get in lots of fights about this in corporate America, and we have to meet in the middle and say, which is more important, and we gotta roll the dice on the other department. And so when we don't kumbaya, which is 80% of the time, we gotta make sure that this works. So just because they tell you you can do solar tax credits doesn't mean you can. We have to understand when you bought it, how you bought it, all these other things, okay? Then we've got charitable deductions. Regular charitable donations, okay? These are great, but again, you're just writing a check. Like, if you guys look at the actual tax returns of charities, you're gonna notice 90% of it goes to administrative costs. That's paying for their employees. It's not going to help the cause. It's not going to fix anything. And this is where you really need to understand where you're putting your money, because Red Cross, they've got CEO, CFO, director, VP, like all this top heavy, expensive people, and they're paying them. And so the money that's left over, it's like 20 cents on the dollar. So be very careful when you're doing charity, because at the end of the day, it's not always going to your cause. So be very careful, and you can't take a charitable donation on your own charity. So be careful in this regard. It has to be set up right. I was told about privately managed associations. Like, guys, come on. Let's just follow the rules and not end up in jail. That's much better, okay? And then here I would put next businesses. Businesses are great tax deductions, but if you're a high charging head of international tax like I was, I hit a point where I was on a different continent every other week. And when I was home, the last thing I want to be is checking on my business. I get told a lot about equipment rentals. That's a business, guys. You're buying equipment to lease out. You're only as good as your operator, and if your operator isn't leasing them out, you're not making any money. And when economies plunge, what's the first thing that stops? Leasing. They will take their assets that they already own and run them longer hours and do morning shift, evening shift, and rentals aren't going to happen. So be careful. Right now, we're headed out of a bull market. We've been going up since 2011, and we're starting to teeter over into a bear market. What works in a bull does not work in a bear. So be very careful. Will you get the tax deductions? 179, one big beautiful tax act? Yes. But that's all you're going to get. And you're basically, again, like charitable deductions, sending your money out the door. Again, solar tax credits, just sending the money out the door. You're not getting any return on your investment. This is why I have them in this category. Okay, now let's talk about threes. Threes, I would say in general, I'm using generalizations, real estate. Right now, I would put Section 8, rentals. Why? Because we had 3 months of Doge this year where everything stopped. We've had a government shutdown where payments stop. These are all things. You are at the government's mercy. In the last 10 years, I can't even count how many times we've had a government shutdown. When there's a government shutdown, people don't get paid. I went to Fleet Week in San Francisco. The Blue Angels didn't show up. We'd have the Canadian Airmen come and save our freaking Fleet Week because the government was shut down. So this is when government, you're relying on someone else to pay you, and that's very, very dangerous. And that's not how you build a bulletproof business, okay? So be very careful. Another one I would put in this category is O&G, oil and gas for average people, right? Why average? Because if you're going off of an ad, good oil and gas funds don't need ads. They have word of mouth. They're at the upper echelon and everything is referral basis, not ads. So be very careful. People who are buying ads need investors. They don't have a reputation. They're newer. These people drill dry wells, okay? So be very careful because it's who you know, it's not what you know, and you want to buy into a network that's safe, sound, tried, proven, tested, rather than gamble with people who are going to pay to get you to invest. And be very, there's a very big difference in this, okay? Now let's talk about 4 for W-2. 4 is great because this is when we get to start to play with different things. So again, I would put real estate funds here. Why? Real estate funds. What are they doing? Real estate funds are doing data centers, storage, senior living facilities, multifamily. All these different funds have GP, LP splits. You're giving them money, you're a limited partner. You're operating it, you're getting a general partner. So they have different tax classifications. If you don't know what that means, go to my other video. It's on my YouTube channel. And this is really important because real estate funds, if you have a joint venture or a general partnership, can now move up to a number 5. Why number 5? Because these now can offset your W-2 income and reduce your income down, subject to the limitations. If you're $1 million earner, you have limitations. Be careful. So that's what's great about these. But if you're passive, limited partner, this is now passive unless you meet the real estate professional rules, which again, that's a whole nother video. Go on my page. We'll talk about that later. But generally, if you're a limited partner is passive, this is where if you're an executive and you have a lot of capital gains from stock from the company that you held and it appreciated and you want to sell, this will offset your stock gains. So this is where we need to know what bucket, what is where, and how it works. And that's another video. So these I think are great, but you need to know if they're active or if they're non-passive or if they're passive. This is very important because passive now I would put down here. So again, non-passive would go up, so it just depends. But you gotta know the rules of real estate. It's not black and white, it's not simple, really, really technical. Now, what I would call fives would be oil and gas, O&G, with my funds, not my funds personally, but my network, okay? My network. So it's not what you know, it's who you know. I earned my way in to the top network, guys. I suffered, I slaved, I did 7 years at Ernst & Young, which if you know any CPA, they'll tell you I'm a martyr, I'm a slave, I'm on a modern day form of slavery. And I worked 20-hour days, 7 days a week, 7 years straight, plus in my corporate career. So my network, I know who's making money. I know which VCs are making money. I know which accelerator programs for VCs are making money. I know which funds are doing what, where, how, who's operating them. So my network has a premium. My network is giving you the top tax deductions and the top income, annual income rates at levels that people aren't seeing. The last 2 years, my clients are getting 25% or more. That's rare, guys. You don't see that in oil and gas, but they're OGs and they have oil and gas. So they know what they've been around the block, they know how to buy, they know how to inspect, they know how to do their research. They've never drilled a dry well, unlike these guys down here. So again, your network is your net worth, and you want an automatic front row seat into what's gonna work. And that's why working with me, I open up my network. I don't get paid by them. I don't make money off of them. They're not mine. I don't let you invest in my funds. That's for a whole nother different topic. But for tax purposes, I have no conflict of interest. I'm not selling a product, I'm offering a service. So this is really important, but you're getting to buy into the people that I know are making money, and good money, above average money. And that's how I became a multimillionaire by 32. So I would say oil and gas for my network, in my network of funds. I would also say certain types of real estate. So let's talk about if you are directly, actively buying auctioned properties, if you are buying pre-foreclosure, so sub 2 would be pre-foreclosure, or taking over a mortgage. Those are all great things. So we can write sub 2. It's similar, if not different, but you're buying the mortgage, you're getting it pennies on the dollar. Or if you also are buying real estate owned assets at banks, REOs. These are at banks, okay? So this is you're getting pennies on the dollar. Right now we're buying about 60 cents on the dollar in my fund. So this is where you get, when you buy at 60%, the market has to go lower than 60% for us to lose money, which is rare. Doesn't normally happen. We've only had 6 years of down markets in real estate since 1942, okay guys? Pay attention to the data, pay attention to statistics. So this would be a business, so you're buying directly, and this would now make it active and qualify you towards real estate professional hours, and then you have to go through all the tests, okay? Then there's different real estate funds. So funds in real estate that I like. Let's talk about them. Data centers. These are really hard to get into. I work with people who are building data centers. They do not have funds. They're going to big, deep pockets all the way to the top. They have their own multi-billion dollars of investments. These are not open to everyday people. I can open them to my accredited network. If you're making $250,000 or more, I can open this to you through my registered investment advisory firm that I work with. So data centers are very exclusive because they're solving a problem for the future. So only the elite get to get in there. And that's what you get my network, okay? So I can get you into these funds. The other thing I like are senior living facilities. Why? Because the boomers aren't getting any younger. In the next 10 years, they're gonna croak. They gotta go somewhere because we're too busy working 3 jobs trying to pay bills. And that's what they did to themselves. So they don't get to live with us because we're not gonna be home because we're working. That's what they did to themselves. And then I also think when people move out, I really like storage. When you lose your home, market tanks, you've got to consolidate housing. You go from your 1 bedroom, you move in with your parents, you're going to put your stuff in storage. Storage is going to get fuller. They're already full in certain rural areas, depending on the market. Storage Americans love to store their stuff. I know people have 4 storage units in every city they ever lived in. Drives me crazy. I don't know why they do it. So if you're a W-2 earner, this is what I would invest in. And this is how I would invest based on the categories and your network, right? Your network is your net worth. And this is really important. Now let's shift over to businesses. So if you are a business owner, S Corp, LLC, sole proprietor, C Corp, some of this stuff we can only do in C Corps. Some of the stuff we can do in both, okay? But remember, there's always limitations on flow-through entities into 1040s. And if you're making more than $313,000 single, $626,000 married, you're limited on how much you can reduce that income by business losses, which is all these kinds of tax deductions. So businesses, C Corps, they have no limitation. They're a different legal entity. They have different rules. We love C Corps. That's why C Corps only pay less than 10% into the Treasury Department's budget with their tax bill. So don't get me started. That's a whole nother video. Go look at that video. So now, if you are a business owner and you are buying vehicles, you're losing. You're buying something that depreciates. It's a one-time deduction. When you go to sell that vehicle, you're gonna have depreciation recapture. Ha 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 ha, that goes to your gain. Sucks to be you. Shitty tax planning, guys. It goes out the door, you're pissing your money, you may as well go light it on fire, give it to the government. Doesn't matter. Because if you don't need that thing for your business and you're gonna keep it for several years, have fun with the depreciation recapture. Terrible idea. Same thing with equipment rentals. Where is it? It's over here. Equipment rentals. You're taking a big deduction. If you're not gonna stay in that business, you're gonna sell it, you're gonna have recapture, guys. This is the devil of real estate and business tax space. Anything you've depreciated and expensed, you sell for a profit, you have a gain, guys, because there's no basis, you wiped it out. So don't do this. Save yourself. There's other deductions you can do. Another thing, as an employer, employee bonuses, great for employee retention. They love it. But again, you're writing a check, that money is going out the door, you're never gonna see it again. You're just gonna see it in smiles on your employees, and if you're cool with that, I'm cool with that. If you have no other choice, give your employees bonus because they'll love you and they'll stay. And your employees are what make you a loaded business owner, so take care of them, unlike the boomers. W-2, so if you have a C Corp, this is for C Corps, increasing owner W-2 income. If you're a C Corp and you increase your owner's, yes, you have a deduction in your C Corp, but you now have a 37% exposure on the W-2 side, which you got to run through all of these things to wipe out. So you're shifting the tax risk. Over here, you have a flat 21% tax in C Corp land. Over here, you have a upper of 37% tax bracket. So again, we're managing everything. Number 2, I mean, there's like SEP plans, simple IRAs, there's solo 401ks, like these are all great, guys. But what happens if you get a really big contract one year and you're like, shoot, I'm stuck, what do I do? How am I gonna wash my bill out? You can't wash it out with these, you're capped. This is what every single employer gives to their employees, and you can only do 23,000 something, 26,000, maybe you get a bonus because you're over 50, whatever. You're not gonna be able to really take 6 figures or more out of these deductions, okay? Yeah, vehicle maybe, depends, you know, you can get the deduction, but again, you go to sell it, you're gonna have recapture. So we want big deductions, okay? We like big deductions that are going into investments. Now, if you're in a business that has equipment and you know your business is growing and you know your pipeline is built and you're gonna need more equipment, if you buy the equipment at the end of the year, I'll give you a 3 on that one. You're basically saving taxes, which is great. But if you're front loading equipment that you're gonna need later, like next year, again, you're saving taxes, you're buying something in advance, so that's good. It's a timing, right? You're accelerating it in. But at the end of the day, it's still equipment, it's depreciating. You sell that equipment piece, you're gonna have tax. So really, equipment, I'm okay with it, give or take. If you prepay inventory, this is great. Pre-tariffs, Great idea. I know people who loaded their warehouses up of construction material at pennies on the dollar, and they're now selling it 6 times the price. And they had big warehouses, storage facility warehouses, industrial storage. So this makes sense. If you know there's an event that's going to cost you increases in your build of materials, prepay it. But again, you're just moving the deduction between years and you're kicking the can down the road. You're not really doing any tax planning. So these are great ways at year end, if you're in a crunch and you need to do it, because you're going to use it in your business. You have business purpose rather than a vehicle you're just doing just to have. There's no business purpose if it's going to sit. I know a contractor with 27 trucks, like pickup trucks, and he used 3 of them. It's a waste of money, you guys. It's a complete waste of money. Don't do it. So then let's talk about real tax planning. So again, if you're a C Corp only, this is important, C Corp only, I'm gonna label it C Corp only. For services-based companies, they get a lot of upfront payment. I love accrual basis. Accrual basis is much more complicated accounting because you're not just tying it to bank statements. You gotta like anticipate what's coming, what's gonna come. This is much more complicated, but if you're getting big services bills, say October, you get paid for the next 6 months of services, and you have 3 months that's taxable in this year and then 3 months that's taxable in the next year. If you are an S Corp, you cannot be on accrual basis because it flows into a W-2, an individual. That is a cash basis person. So this only applies for C corporations, not corporations, taxes, and S Corp. Be careful. S Corp jail is real and it's hell, and I freaking hate S Corps, but that's another video. The other thing I would say is if you are a solopreneur, oops, I spelled this wrong, ignore that. Solopreneur, I really like profit sharing, cash balance, 401ks. Running out of space. I like these because I can take per owner. So if I have no employees, I use only contractors, 1099, and I don't tell them when they work. I don't give them a uniform. I follow all the rules. It's a whole nother discussion. If you are a solopreneur and you're making a boatload of money, you can hire yourself as an employee, right? You're a business owner, so you have a W-2. So you can hire yourself, pay yourself a good enough salary, and you can put up to $350,000 away in profit sharing, cash balance, 401k. There's 3 plans we smash together. I call it a super 401k. And this is like a supercharged 401k. And we can get up to $350,000. It is basically 401k contribution, defined contribution meets defined benefit added together, okay? So pensions. Back in the day, there used to be pensions. I have a pension from Ernst & Young. Love you. Thank you, Uncle Ernie. But pensions are real and they get paid and the company prepays into them. So this is where the company gets an expense. There's no income over here because it's pre-tax, tax deferred income, but you get the deduction now. So this is a great one if you're a solopreneur. I put it here because it only really works for solopreneurs, but we can do it in any type of entity. So we can do it in an LLC, a Schedule C, sole proprietor. We can do it in partnerships. We can do it in all kinds of different plans, but it applies to every business that you own. So the minute you have 2 employees, it now applies to them too. So we really want this to be for solopreneurs, and that's why it's where it is. Okay, so now let's talk about one last really good deduction, and I say this is for marketing purposes only, dependent on your business, okay? So I'm gonna put a big marketing supercar. Why supercar? Because I do a lot of real estate. I do a lot of tax planning for very wealthy people. I work with billionaires and family offices. If I show up in a supercar and I have my label all over it, people are gonna come and talk to me. One, you have to have your company logo on it in order to be tax deductible, okay? You can't just have a car. It's not like, yay, I have a car. Like, you need to have your freaking company logo on there and it needs to be big. Think Formula One big, think Grand Prix big, okay? So you're using this for marketing purposes. And this is gonna give you extra access to elite fields. So if you're not in an elite field, then don't do it because it's really hard to justify. So supercars and yachts, okay? Again, they're twos because they get you access to people who have deeper pockets, but you need to use them for business. They need to have your business all over it, and you need to be in a populace that would benefit from the elite, okay? So this is why you see yacht people, they're like, hey, come, let's talk about investments. We're gonna talk about this day on my yacht, and that whole trip is expense, the gas, everything. And they do it by day. You have to track it. It's not easy, but you can do this, and it's super helpful. If you work with elite people and you need deep pockets, you can deduct it. But if you're like Joe Schmo, the plumber with like $400,000 of revenue, you're not in the elite. You're not even in commercial real estate. If you're doing single family, you are not going to be able to expense this. So again, boats, cars, be very careful. There's lots of stringent rules. Okay, now let's talk about the fives. My favorite part. So these are changing how you're doing your revenue recognition. This is an investment. This is a fully depreciated upfront. Airplanes too, we could add airplanes, but those are really expensive. Yachts are really expensive. So your cars are really expensive if you do it right. Don't buy the $250,000 Ferrari with a clutch issue, okay? Rich people know what that's about, and you look stupid. And we're gonna be like, oh, he bought his way into the club. He's a bottom. He's coming up. He's up and coming, okay? So we know, because we know what a $3 million Bugatti looks like, okay? And no one's gonna go near it. They're not gonna be revving the engine. They're not even gonna waste their time on it. So let's talk about the Holy Grail now. Holy Grail. If you're a solopreneur, again, or a business owner, I really like captive insurance plans. So what is a captive? A captive is basically you build your own insurance company. I hear that these are on the Dirty Dozen. I hear all these things. Look, guys, it's who you know, how they build it, how they do it. If you are a micro captive, you're right, it's very difficult. But if you are a captive that buys into a bigger consolidated captive, which qualifies as a full captive, now you bought into a network and you get all the tax benefits. So again, not all is created equal. Oil and gas, average people, oil and gas, my network, okay? They're producing higher tax expense deductions and higher income than someone who's marketing, begging for people. Doesn't make sense to me, but that's how it goes. So same thing, not all is created equal, and depending on, you need to have millions of dollars before I will even entertain a captive insurance. And you want to do this if you have a C Corp. You don't really want to do this. You can do it with an S Corp, but it's not as fancy and exciting. So captive insurance, you're paying a premium. Now you have a second incorporation that's owning the insurance policies and the insurance. This is great for people who have cybersecurity, privacy protection, HIPAA, doctors, people who have very important data that could get breached and hacked. But also, if you're a solopreneur and if you get hit by a car and you get hospitalized, we need to hire somebody else and your revenue is going to drop. You want to get reimbursed for that because that's how your family's living. That's how your business is operating. That's how it's surviving. So again, this is for people who don't know how to delegate and build proper teams. Captive insurance will save you the day. So I love captive insurance. This applies to all types of businesses. So it's very helpful. But again, it's great. We buy into bigger captives. So you're getting pieces of. For C Corps only, I like executive bonus. I back my executive bonus when it's a sole prop to life insurance. So you could look up Jim Harbaugh. He took $4 million loan rather than $5 million of pay. He said, pay me $1 million, Michigan, give me $4 million. He had $15+ million on the back end. Some estimate $65 million, depending on how his investment manager manages policy. These can be very powerful, very, very powerful. It's a way to take the money back from the government, put it into something that will generate income. That's why it's a 5. Captive insurance generates income, but you need to know how to exit C Corps, tax-free, tax deferred. So all of these come with complexity, and that's where you need somebody who's really good at what they do, okay? If you have a business, I always love business headquarter offices with other spaces that you can rent other offices, okay? Because these people can end up paying the lion's share. You take the smallest office if you don't need office space, and you rent the rest out. They're gonna pay the lion's share of your mortgage, property taxes, insurance, maintenance, yada, yada, yada. And then you just manage the outside of the building and you manage your piece. So these are great deductions, great way to get into commercial real estate, get a lot of cost segregation up front. I really like these, and it's great because we can make it a business asset. Again, don't put real estate in an S Corp, guys. Don't. I'll kill you. I'll choke you. Don't put tech that's going to grow and become very profitable in an S Corp. I will choke you and kill you. Put you in S Corp jail. We cannot restructure you tax-free. So don't do it. So you want to put it in a different LLC. Business funds it. And then the other thing I would say is if you own a business, buying a business in your industry, I think this is a great way for you to get accelerated appreciation. If you are in a business and it's a profitable, let's add profitable. This is key. So you're not trying to correct a dead horse and drag it off and make it run again. We want something that's profitable. If you're buying an already profitable business like me, buying a tax planning firm, they have clients that like tax planning, that like to be a little bit more aggressive. They're willing to take chances. They're willing to trust and try. These are great for me. If I buy one that has real estate, I can cost segregate that. If I buy desks, computers, chairs, monitors, whatever, I can deduct all of that up front. So you can back in, some people call this tax acquisition strategies when you have a business. You can buy a bunch of assets, take those deductions, and then that will wipe out your tax bill. So there's different ways. This is why 8, 9, and billionaires, figures, 10 figures, they buy so many businesses because they're basically consolidating with their profits and buying tax deductions, and they're putting 10% down on an SBA loan and they're getting millions of dollars of deductions. It makes sense. It wipes out their tax bill. So I love this because it's cash flowing, it's profitable, and you're adding a client list, you're adding tax deductions, you're adding. This is nothing but up, guys. And if you're planning on keeping it for a while, you're gonna win. So this is how I would break down everything. And if you're making over $250,000, click the link below. I want to work with you. I want to help you. I want to get you into these types of tax deductible investments, ideally 4 and up. If we have to do 3, I'll do 3. But I always tell people we would rather put it in something that can generate you income and get you other streams of income than write a check to the government. So Lord knows we're not going to see that. So click the link below if you want to work with me, $250,000 or more in income, and I will work with you. I'm not taking clients after December 1st. That's my policy. So get in for 2025 ASAP. Or if you're watching this in later years, get in. These will change as an economy changes, and as things change, I will shuffle these around. So stay tuned on my YouTube, click and subscribe.